Dividend investing is dead, or at least that's what the growth bros on social media want you to believe, while they're busy losing 40% on unprofitable tech stocks. But before we bury the dividend, let's ask a more uncomfortable question. What if the real dying strategy is ignoring cash flow altogether? Here's the thing, corporations didn't just wake up one day and decide to stop paying dividends out of spite. Buybacks became the tax-efficient darling of the boardroom, starting in 1982, when the SEC quietly loosened the rules and handed executives a legal way to juice their own stock options while calling it shareholder value. Think of it like this. A dividend is the company writing you a check every quarter, while a buyback is the company buying back the poker chips from the table. It raises your stake without ever touching your wallet directly. One is transparent and tangible, the other is financial sleight of hand dressed up in a press release. We went from an era where AT&T and Coca-Cola were the rock stars of your grandfather's portfolio to a decade where yield became a dirty word, whispered only by retirees and people who still use Internet Explorer. The S&P 500's average dividend yield has collapsed from over 4% in the 1980s to barely 1.3% today. That's not a trend, that's a structural shift. And psychologically, investors have been gaslit into believing that a company rewarding you with actual money is somehow less sophisticated than one hoarding cash to repurchase shares at all-time highs. Howard Marks once said that the most dangerous thing in investing is the belief that risk has been eliminated, and right now, a lot of growth investors are living in exactly that delusion. History, though, has a wicked sense of humor. After the dot-com crash, dividend-paying stocks outperformed growth stocks for nearly a full decade, and nobody who was busy chasing pets.com wanted to hear that lesson until it was already tattooed on their losses. Here's the cycle nobody talks about. Cheap money inflates growth stocks. Expensive money deflates them. And dividend stocks quietly compound in the background, like that one boring friend who actually shows up when things go wrong. We've seen this movie in 1973, 2002, and 2008. The titles change, but the plot rhymes every single time. Now let's kill the biggest misconception before it kills your returns. People think dividend investing means buying crusty, slow companies going nowhere. In reality, dividend growers like Microsoft, Apple, and Visa have crushed the broader market over the last 20 years while paying you to hold them. And the buyback argument? Yes, a well-executed buyback can be more efficient than a dividend, but when companies borrow money at artificially low rates to buy back shares near market peaks, that's not capital allocation genius. That's just legalized financial vanity. The dividend forces discipline. The buyback enables ego. So what do you actually do with this information? You don't go all in on high-yield dividend traps paying 8 or 9%, because if it looks too good to be true, the dividend is probably being funded by debt and prayers. Instead, you focus on dividend growth companies that have raised their payouts consistently for 10, 20, 30 years because that track record is the closest thing to a corporate lie detector test. Position size matters more than conviction. Here, you don't bet the house on any single yield play. You build a diversified ladder of growing income streams that compounds quietly while you sleep. The strategy isn't about getting rich fast. It's about building a machine that pays you more every single year, regardless of what the market is doing. Here's the philosophical gut check. The best investors aren't the ones who pick the hottest strategy of the decade. They're the ones who survive every decade with a process intact and their emotions in check. Dividends aren't dying, they're just unfashionable right now. And if you've learned anything from market history, unfashionable is often where the next opportunity is hiding. Whether the market rewards patience next year or in 5 years, you don't actually need to predict the timing. You just need a rational plan, consistent execution, and the emotional discipline to not panic when everyone else is. The beautiful irony is that the strategy Wall Street keeps calling obsolete keeps quietly compounding for the people boring enough to stick with it. And if you're ready to stop debating and start building, whether that means dividend portfolios, real estate income, or finding the right lender to put your capital to work, check out our links in the description below because we can help you get started.